So there are ways to view equity requirements as a very powerful tool for keeping the health and safety of the system. There are lots of policy variables that are used out there. The Fed often changes interest rate, and in exchanges where they want to guarantee the safety of transactions, they use margin requirements. If equity requirements were viewed as something that can be used flexibly, it's not like a number, like 30% at all times should be equity, but more, I look at the economy, I look at the extent of leverage and systemic risk, I look at what you've got in your assets, and I decide what you need to have. And then I, as a regulator, help you get to a healthier place in the space. Then it can be quite a powerful and flexible tool, and we would all save potentially on financial crisis. Because in particular right now, I would say one of the immediate things that we recommend in our paper is that the regulators basically ban banks for a while until they're better capitalized from paying out in the form, for example, of dividends to their equity holders. We believe that it is really not a good thing that the government has allowed banks to pay dividends throughout the crisis, even as they were trying to give them more capital. So the banks really are not in a good position to claim that they cannot lend and they do not have enough capital when they keep paying dividends to the tune of maybe $130 billion paid in the last 2 years to bank shareholders. Many companies in the real economy, if they have good opportunities, just do not pay dividends. So we believe that a combination of constraints or controls of payouts, and the money still belongs to the shareholders, it just is not paid out, and equity issuance mandates by regulators, and overall a sort of sense that equity requirements are a way to maintain the stability and health of this system is a very powerful approach that regulators are not quite in the right place, in our view, to use effectively as they could.